What's up, everybody? Continuing with the basic principles series, today we're going to talk about the accounting equation. Now, just like any other financial principle that we've gone through so far, this applies to both businesses and individuals, and this relies on something called the double entry accounting model. And what that means is if you look at the balance sheet of yourself or a company, on the left side you'll have what you own or your assets, and on the right side you'll have what you owe. And this can actually be in two forms, in the sense that it can be liabilities or it can be shareholders' equity. Now we have separate videos breaking down what assets, liabilities, and equity are, but simply put, assets are what you own that bring money into your pocket, liabilities are what you owe or take money out of your pocket, and equity is essentially the difference, and that is what the accounting equation is. So essentially you can look at the equation as assets equal equity plus liabilities, or equity equals assets minus liabilities. And the reason this equation is so important is because it's important to recognize that both sides of this chart or this balance sheet always have to remain balanced. And this gives you a good idea of in your personal finances, what's coming in, what's going out, and where those balances lie and what you can adjust. And similarly, if it's a Fortune 500 corporation, they use the same ideas to figure out, hey, what do we have coming in? What are we spending on? And it just gives you an overall view of your finances. Now let's go through some examples to really bring it home. Let's say I'm the owner of a t-shirt company and I put in an initial investment of $20,000 to buy $20,000 of t-shirt inventory. Now, as you can see here on the asset side, we have an inventory of $20,000 worth of t-shirts, and on the equity side, we have $20,000 owed to me as the owner because I'm the one who put in that cash, and overall, you have a balance of $20,000 on the left side and $20,000 on the right side. Now, let's say now I want to buy a printing press and I take a loan out from the bank to buy a printing press. Once again, as you can see on the right side, the $50,000 loan is a liability, it's something that I owe. And on the left side, the printing press is an asset worth $50,000 and it stays on the left. And again, as you can see on the left side, we have $70,000 equaling on the right side $70,000. Now, obviously, these are very simple ideas to get the point across, but it can get very complex as a business grows and it has more assets and more liabilities. And similarly, in individual finances, it works the same way. As you buy more and more things, as you take out more and more loans, there's more things added to the left and right side of this equation, but always it's equal at the end of the day. So guys, hopefully that was helpful. Hopefully you understand this very basic principle. We are going to get more and more complex as we move forward, but it's very important to have an understanding of the foundations before you get to the fancy investing and getting rich stuff. So hopefully that was helpful, and we'll see you next time.